There is a moment in every cycle when something shifts, not suddenly, not dramatically, but quietly beneath the surface. Most people miss it, because on the surface, everything still looks normal. Stocks are stable, bonds are trading, the system appears intact, but underneath, capital is already moving. And right now, we may be entering that moment again. Silver just reacted, not after a major announcement, not after a shock event, but during a period when global pressure is starting to build. Global debt is now above $300 trillion, U.S. policy direction is becoming less predictable, and geopolitical alignment is starting to shift. These are not isolated signals, they are connected. Because when capital begins to question stability, it does not wait for confirmation, it starts to reposition. And silver often reflects that repositioning early, because it responds to both monetary stress and real demand at the same time. Right now, several signals are appearing together. Debt is rising, costs are increasing, alignment is shifting, and capital may already be moving. This is how transitions begin, not with noise, but with signals. If you have been watching this channel for a while, you already understand this pattern. Markets do not break when everyone expects them to break. They shift quietly, while most people are still focused on what is visible on the surface. That difference matters. Most investors react to headlines and wait for confirmation before they act. They wait for clarity, for official signals, for something that feels certain. But by the time clarity arrives, the move has already happened. This channel is built on a different approach. We do not follow noise and we do not chase short-term price action. We focus on structure. We pay attention to how capital is moving, how risk is being priced, and how pressure is building inside the system. Because real shifts do not begin with sudden price spikes. They begin with positioning. They begin with small changes in behavior that are easy to ignore at first. Changes in allocation, changes in liquidity, changes in how different parts of the system start to respond. At first, these changes are almost invisible, but over time they begin to connect. And once they connect, the shift becomes unavoidable. That is why we pay attention to signals like silver, not because it is the most popular asset, but because it often reacts when something deeper is happening beneath the surface. This is not about predicting exact prices or chasing short-term moves. This is about understanding timing and recognizing structure. It is about seeing shifts early before they become obvious to the majority of the market. So if you are here, you are already ahead of the curve, not because of luck, but because you are choosing to focus on the right signals. And right now, those signals are starting to align again. Let's step away from narrative for a moment and look at the actual data. Right now, silver in Western markets is trading around recent highs, holding above key levels after a strong upward move. But the more important signal is not just price, it is the divergence. In Shanghai, silver continues to trade at a premium compared to Western spot prices. In some sessions, that premium has remained persistently positive, indicating stronger physical demand in the East. That difference matters, because when physical buyers are willing to pay more than the paper market price, it suggests the global pricing mechanism is under pressure. Now look at COMEX inventory. Registered silver, which is available for immediate delivery, remains tight relative to total demand. At the same time, eligible silver exists, but it is not committed to delivery. That distinction is critical, because not all silver in the system is actually available when needed. Now consider open interest. Total open interest still represents a significantly larger amount of paper silver than what is currently registered for delivery. This creates a coverage imbalance, a situation where the number of claims exceeds the immediately available supply. Historically, that imbalance does not need to resolve immediately, but it creates pressure. Now look at recent changes. Open interest has been adjusting, but not collapsing, which suggests positioning is being managed, not unwound. At the same time, ETF flows have shown periods of stabilization after previous outflows. This indicates that large-scale liquidation is not currently accelerating. Meanwhile, physical demand in Asia remains firm. Premiums have not collapsed. They have held. That tells us something important. Demand is not weak, it is persistent. So when you combine these elements, a pattern begins to emerge. Western pricing remains anchored in paper markets. Eastern demand reflects physical reality. Inventory remains limited where it matters, and total claims still exceed immediately available supply. Individually, none of these data points confirm a breakdown, but together they describe a system under tension. To understand what is really happening, we need to separate two different layers of the market. The first is the paper market, and the second is the physical market. Most people only see one number, which is the spot price, and they assume that price reflects real supply and demand. But in reality, that price is largely determined by paper trading. It is shaped by futures contracts, derivatives, and positioning flows rather than the direct exchange of physical metal. Now compare that to what is happening in the physical market. In Shanghai, buyers continue to pay a consistent premium above Western spot prices, and that premium has not disappeared over time. That observation is important, because it tells us that real buyers who require actual metal are willing to pay more than the quoted price in the paper market. This raises a fundamental question. If the paper price fully reflected real supply and demand, why would a persistent premium exist in the physical market? Why would buyers accept a higher price if the lower price was truly accessible in practice? The answer is not necessarily manipulation, but rather the structure of how these two markets operate. The paper market is designed for liquidity and scale. It allows large volumes of contracts to be traded quickly, often without any intention of taking delivery. Most of these contracts are rolled forward, closed out, or offset before expiration. The physical market operates differently. It requires actual metal to change hands, and transactions are constrained by real availability. When demand increases in this part of the system, price signals begin to diverge from the paper market. That divergence is what we are seeing now. On one side, paper pricing suggests relative stability. On the other side, physical pricing reflects ongoing demand and tighter conditions. The gap between these two signals is where the real information begins to appear. Because when that gap persists or expands over time, it forces a resolution. Either physical demand weakens and premiums compress, or paper pricing adjusts upward to reflect the true cost of acquiring metal. At this moment, premiums have not collapsed. They have remained present, which suggests that demand is not fading but continuing. And when persistent demand meets limited deliverable supply, the result is not immediate disruption but sustained pressure building inside the system. To understand where real pressure appears, we need to look at how delivery actually works, because most activity in the silver market does not involve physical delivery. It involves contracts. On COMEX, traders buy and sell futures contracts that represent silver. Each contract gives the holder the right to take delivery of a fixed amount of metal. But in practice, most contracts never reach that stage. They are closed or rolled forward before delivery begins. This brings us to an important concept called First Notice Day. First Notice Day is the point when a contract can be assigned for delivery. If a trader still holds a long position at that moment, they can be required to take physical metal. Because of that, many participants exit or roll their positions before this date. They avoid delivery. They stay in the system, but they do not demand metal. This is how the market maintains balance most of the time, but that balance depends on behavior. It depends on participants choosing not to take delivery. Now consider what happens if that behavior changes. If more participants decide to stand for delivery instead of rolling their contracts, pressure begins to appear. This is where the concept of coverage ratio becomes important. The coverage ratio compares the total number of paper claims to the amount of registered metal available for delivery. When that ratio is high, it means there are many more claims than immediately available supply. Under normal conditions, this is manageable, because not everyone asks for delivery at the same time. But if demand for delivery increases, the system becomes more sensitive. Now add another layer, the structure of the futures curve. In a normal market, prices are in contango, meaning future contracts trade at a higher price than spot. This reflects storage cost and time value. What we are seeing now is not entirely new. Markets have gone through similar phases before, moments when pressure builds quietly beneath the surface, long before it becomes visible to everyone. One of the most well-known examples happened in 1980. During that period, silver prices surged dramatically in a very short amount of time. The move was not driven by a single headline. It was driven by a combination of factors: rising inflation, monetary instability, and concentrated demand for physical metal. At one point, silver reached levels that forced exchanges to intervene, position limits were introduced, rules were changed, and the structure of the market shifted rapidly. Then came 2011, another period when silver moved aggressively. This time the backdrop was different, but the pattern was similar. Global financial stress following the 2008 crisis, central bank intervention, and a surge in investor demand for hard assets. Silver moved from under $20 to nearly $50 in a relatively short time. Again, the move did not begin with widespread attention. It began quietly, with positioning and demand building beneath the surface. There is also a broader lesson that appears across different markets. In The Big Short, the key insight was not about predicting the exact timing of the crisis. It was about recognizing that the system was mispriced, that risk was being underestimated, and that once pressure reached a certain level, adjustment would not be gradual. It would be abrupt. The same idea applies here. These events do not repeat in exactly the same way, but they often rhyme. They begin with imbalance. They build through pressure, and they resolve through repricing. Right now, we are not at the resolution stage, but the early conditions are starting to appear, and that is when paying attention matters most. But under pressure, the market can shift toward backwardation. This is when near-term prices rise above future prices. That shift suggests immediate demand is stronger than future supply. It is a signal of tightness, so when you combine these elements, a clear picture begins to form. A system built on paper contracts, a structure that relies on most participants not taking delivery, and a limited pool of registered metal that must satisfy those who do. Most of the time, this system functions smoothly, but when behavior changes even slightly, pressure does not disappear. It concentrates. And once that pressure reaches a certain point, the system is forced to respond. To fully understand the current setup, we need to step outside the market itself, because silver is not just a financial asset, it is part of a global supply chain, and that supply chain is not evenly distributed. Mexico remains one of the largest producers of silver in the world, which means any disruption in production, regulation, or export flow can have a direct impact on global supply. Even small changes in output can tighten availability over time. Now look at demand. China plays a central role, not just as a consumer, but as an industrial driver. Silver is used in solar panels, electronics, and energy infrastructure. As the energy transition accelerates, demand for these applications continues to grow. That demand is not speculative, it is structural. India adds another layer. Traditionally, India has been a major buyer of physical silver, especially during periods of currency uncertainty or inflation. When local conditions shift, demand can increase quickly. And that demand is almost entirely physical. Now add geopolitics. U.S. policy direction is becoming less predictable. Discussions around NATO commitments are creating uncertainty in global alliances. And when alliances become less stable, capital begins to reassess where risk is concentrated. This matters for commodities, because supply chains depend on stability. They depend on cooperation between regions. When that stability is questioned, even indirectly, it introduces friction. That friction does not always show up immediately in price, but it shows up in behavior. Producers become more cautious, buyers become more aggressive, inventories become more strategic, and flows begin to change. So when you combine these layers, the picture becomes more complex. Supply is concentrated, demand is structural, and geopolitics is adding uncertainty. Individually, each of these factors can be managed. But together, they create a system where pressure builds from multiple directions at the same time. And in that kind of environment, small imbalances can become much more significant. To see what the system is really feeling, we need to look beyond price, because price is often the last thing to move. The earlier signals appear in the derivatives market. One of those signals is the lease rate. The lease rate reflects the cost of borrowing physical silver. Under normal conditions, this rate stays low and stable, because metal is available and liquidity is sufficient. But when the lease rate starts to rise, it suggests something different. It suggests that access to physical metal is becoming more constrained. In simple terms, it becomes more expensive to borrow silver, which means availability is tightening. Another signal comes from swap rates. Swap rates reflect the relationship between physical metal and financial contracts. When swap rates move in unusual ways, especially when they turn negative, it indicates imbalance. It suggests that participants are willing to pay a premium for immediate exposure to metal rather than future delivery. That shift is subtle, but important. It reflects urgency. Now consider volatility. In stable conditions, volatility remains contained, but when uncertainty increases, implied volatility begins to rise. This does not always mean price will move immediately, but it signals that the market is preparing for larger swings. That preparation matters, because volatility is often a response to hidden pressure. So when you look at these signals together, a pattern begins to form. Lease rates rising, swap dynamics shifting, volatility increasing. None of these signals alone confirms a major event, but together they indicate that the system is becoming more sensitive, more reactive, more fragile. And in that kind of environment, it takes less force to create a larger move. At this point, it is important to consider the other side, because not every signal leads to a major shift, and not every period of pressure results in a breakout. There are several reasons why this setup may not develop further. First, premiums in the physical market could compress. If demand in Asia slows down, or if supply flows improve, the gap between physical and paper pricing may narrow. That would reduce the pressure we are currently observing. Second, ETF flows could reverse. If large institutional holders begin to reduce exposure, it could introduce additional supply into the market. That kind of selling can offset physical demand, at least in the short term. Third, exchanges can respond. If delivery pressure increases, mechanisms such as margin adjustments or position limits can be introduced. These actions do not remove pressure entirely, but they can delay how it appears in price. We have seen this happen before. Fourth, geopolitical conditions could stabilize. If uncertainty around U.S. policy decreases, or if global alliances become more predictable, capital may shift back toward financial assets. That would reduce the need for defensive positioning in metals. Finally, market sentiment itself can change. If participants become less concerned about systemic risk, positioning may unwind gradually, and when positioning unwinds, price pressure can fade. So it is entirely possible that what we are seeing now remains contained, that the system absorbs the pressure, and that silver does not move significantly beyond current levels. This is why it is important to stay grounded, to focus on data, and to avoid forcing a narrative. Because the goal is not to predict with certainty. The goal is to understand probabilities. If this setup continues to develop, there are several key signals to watch. These signals help confirm whether pressure is building or fading. The first is physical premium. Watch whether premiums in Shanghai remain elevated or begin to compress. If premiums continue to hold or expand, it suggests demand is still strong. If they decline, it may indicate pressure is easing. The second is registered inventory. Pay attention to whether registered silver on COMEX continues to decline or begins to increase. A sustained decrease suggests tighter deliverable supply. An increase would reduce immediate pressure. The third is the futures curve. Watch for any shift from contango toward backwardation. If near-term prices begin to rise above future prices, it signals stronger immediate demand. The fourth is open interest. If open interest declines sharply, it may indicate positions are being closed and pressure is unwinding. If it remains stable while price moves, it suggests positioning is still active. The fifth is ETF flows. Large inflows can support price by absorbing supply. Outflows can introduce additional selling pressure. The sixth is volatility. If implied volatility continues to rise, it suggests the market is preparing for larger moves. If volatility contracts, it may indicate stabilization. And finally, watch the broader macro environment. Changes in U.S. policy direction, shifts in geopolitical alignment, movements in interest rates. All of these factors influence how capital allocates. Individually, each signal provides limited information, but together, they form a framework, a way to track whether the system is becoming more stable or more stressed. And that is what matters most. What we are seeing right now is not a prediction, and it is not a guarantee of what comes next. It is a set of signals, signals that suggest pressure may be building inside the system. Silver is not moving randomly. It is responding to changes in capital flow, in structure, and in risk perception. Those changes are still developing. They may accelerate, or they may stabilize. But they are worth watching, because moments like this do not begin with clear confirmation. They begin with subtle shifts, with small imbalances, with signals that are easy to ignore, until they are not. This is not financial advice. The goal is not to tell you what to buy or when to act. The goal is to understand what the system is doing, to observe the data, to question assumptions, and to make decisions based on logic, not emotion. Because in markets like this, clarity comes late, but positioning happens early. And the difference between the two is where opportunity exists.